Thank you. It's a great pleasure to be with you today. Ukraine is on our minds all the time and in our news all the time. And it's nice to be able to communicate with you in this way. I'm going to talk today about climate risk, but I'm also going to talk about geopolitical risk because they're so closely tied together. And of course, the experience today of Ukraine is this horrible war is one of the devastating examples of geopolitical risk. I have some slides I'm going to show, and what I'm going to do is talk for about half an hour, and then we'll have time for questions. And you can send your questions to Dimitro, and he will ask me. And we'll go from there, okay? So let me start by sharing my screen. I assume you can see this?
Yeah, everything is all right.
So the title I've given is Climate Change and Geopolitical Risk. And I am happy to be part of the Ukrainian Ambassador Lecture Series. And I guess many of you are probably in the Junior Academy of Sciences of Ukraine. And just for your information, my name is Robert Engle. I'm the co-director of the Volatility and Risk Institute at New York University Stern School of Business. And I'm a Nobel laureate in economics from 2003. The unprovoked invasion of Ukraine by Russia is an absolutely terrible event. It is both a humanitarian and economic disaster and an example of geopolitical risk that affects all assets and has a devastating impact on investments and portfolios everywhere. The courageous response of the Ukrainian people and their government has inspired us all. The coordinated response of Western economies to support Ukraine through military, humanitarian, and financial support, including the sanctions on Russia, is unprecedented. But on a personal note, my wife and I visited Ukraine several years ago and very much enjoyed the people we met, the students I spoke to, and the beauty of the country. The news of the devastation of this nation is horrifying to us and to all the people we know. I'm going to start by showing you a map of the world. It's a volatility map of the world, and it's posted on the internet at the site VLAB at stern.nyu.edu. VLAB stands for Volatility Laboratory, and what this map is doing is measuring how great the fluctuations are in asset prices all over the world. It shows the level of the volatility of the stock market in each of many countries every day. When it's red, it means the volatility is much higher than usual. That means it's fluctuating up and down much more than usual. If it's green, it means it's lower than usual. And volatility is measured from a type of model, a Garch model, and this is one of the things that I received the Nobel Prize for. This is an upgraded version from what I did in those days, but this is the basic idea. And so we can apply this to many countries. We can apply it to many assets and asset classes. So here's an example of what this map looks like. You see it's really all green, but this is from 2019. So this is before the pandemic and before inflation, before the Ukraine war. If you look a little more recently, in March of 2020, the map turned red almost everywhere. And this was really the early days of the COVID pandemic. And it was a time when the markets all over the world were devastated by the prospect of what this virus could do. If you look now today, it's also red in most places. It's red the US and Canada, it's red in most of Europe, it's certainly red in Russia. There are other, Australia, there are other places that are not quite so affected, but every day it's a little bit different because markets are responding every day. And so there's a new measurement made every day. If another display that's on the next page in the VLAB is where are the volatilities the highest today? And if you look across countries, Russian Federation has the highest volatility of its stock market, followed by United Arab Emirates and Peru and Indonesia, United States, Hong Kong, and so forth. On the bottom left, we see, look at currency volatilities. Exchange rates are fluctuating all the time. And the most volatile of those is the Russian ruble. And that's by a long stretch over the Brazilian real, the South African rand, and so forth. If you look at industry volatility on the upper right, you can see that the highest volatility is healthcare, which is typically what we see, but also energy and technology, which are not always at the top of the list. And this is, I think, because of the role of energy politics that's going on right now, and the sanctions on Russia and the cutting off of natural gas and so forth makes energy prices extremely volatile. And if you look at the commodities at the bottom, you can see natural gas is at the top. Again, not surprisingly. So the point is that we are seeing high volatility all over the world and over different asset classes. And I'm going to talk to you a little bit about how that happens and how we measure it. And I have a name for it, which is called global COVOL. And what that stands for is global common volatility. That the volatility is common means that all these things have volatilities that should go up together. And what global COVOL actually tries to measure is when asset prices are more volatile than expected in all assets, asset classes, sectors, and countries at the same time. So at the same time is what's important, because that means that there is some event that's made all these things happen at the same time, and the volatility shoots up in all these countries and all these asset classes. So these are the kinds of tail events that surprise us, defeat our portfolio strategies, and lead to the solid red on the map. This is work I've done with Susanna Campos Martins, who is at Oxford University and also in Portugal. And we call them global COVOL events because they are shocks to the global markets that occur at the same time. What causes these events? Well, wars, elections, pandemics, climate change, and often it's the news about these things that actually makes the world's asset prices move. This is really a general view of what we mean by geopolitical events. It's more general than the conventional version of what geopolitical events are, but actually when you think about all these types of events, they are all really geopolitical. So if you look at VLAB, we see some plots here. This is a plot of the global COVOL in VLAB over the last couple of years. And this peak is in February and March of this year, and is obviously associated with the invasion of Ukraine by Russia. You can see that it's come back down again, but is now rising again. It came back down again because these surprises are measured relative to what we expected. So the expectation was high, and so the relative increase was not that great. The war was continuing in a way that didn't offer surprises to the asset markets. It just said, this is a continuing trauma. If you look at the bottom of the page, it lists the 5 biggest days over the last 20 years. And the first 3 are all mentioned. The first one is when COVID really became widely known to be a disaster that was going to hit all countries. And at the same time, Saudi Arabia and Russia started an oil price war where they were going to actually compete to produce more and more oil. The second on there is Brexit, which is an election which affected geopolitical alliances all over the world. And the third is the day that the market in the US reopened after the 9/11 terrorist attacks on the World Trade Center. And those 3 events are all among the 3 biggest we see over the last 20 years. And they're all sort of different, but they all have this big impact. This has big impact for what's happening around the world. On the right-hand side of this page, we do the same thing, but they're all US assets, but all sorts of different asset classes, not just stocks and bonds, but currencies and real estate and commodities and all sorts of things. And it's a little bit different list at the bottom, but the picture is kind of the same. The picture shows the big rise in February and March, decline, and now it's rising again. Okay, so that's an introduction to what I mean by geopolitical risk. And let's call it global COVOL, but it's a little complicated to say. So now I want to turn to a different topic, which is the risks from climate change. And this is a risk we've been talking about for a long time. It's not so imminent as the geopolitical risks we've just been talking about, but it's really coming. Scientific evidence is clear that the Earth is warming. And if you've studied a little bit of physics, you know that when the energy that's received by a body is greater than the amount that gets re-radiated from this body, that's going to warm up. And that's what's happening to the Earth. And the reason it's radiation going out is not enough is because of the greenhouse gases. So the science is pretty well understood. The economic and social consequences are much less clear. Some economists think this is just another risk and it's a manageable risk, while others predict that it is a most extreme risk and could be the end of human species. So what are we talking about? Well, we're talking about risks of storms that are more severe, drought that's more severe, sea level rise, wildfires, species that are becoming extinct, and many other things. But this is a list that gives you the flavor of what we're talking about. These risks are typically now called physical risks, or the physical risks of climate change. And if we think these physical risks are going to be too damaging to our planet, what do we do about them? And that's kind of a topic, a great topic, because we do want to try to stop this before it becomes so severe as it can be. So there are two forms of response to these risks. I'm going to call them adaptation and mitigation. This is a common way of describing it. And so adaptation is what we would naturally do if we correctly assess the physical risks. In other words, we know that these risks are here, but we can do something about them. What can we do? Well, sometimes we want to insulate buildings better, or build seawalls so that the sea level rise doesn't come into our cities, or improve air conditioning and agricultural processes. This kind of adaptation reduces the damages, but it doesn't do anything to slow climate change. Or it's generally not going to slow climate change. In order to slow climate change, what we really have to do is what we call mitigation. And this means reducing the emissions of greenhouse gases. And that happens when we do what we call decarbonizing the economy. We have to move from using so much fossil fuels, burning so much stored CO2 and stored carbon and putting it back into the atmosphere. So there are lots of ways to do that, and we'll talk about those on the next slide. But I want to say that this introduces a new risk, which we call transition risk, which is especially important for firms with high emissions and their trading partners, because transition risk means that some firms are doing businesses which are incompatible with a decarbonized economy. And so we're going to have to find substitutes for those businesses and maybe substitutes for those products. That can be very expensive, and it could be, there are winners and losers, and the transition risk is very serious for the heavy emission sectors of the world's economies. So what are mitigation strategies? Well, governments can impose carbon taxes. And this is a typical recommendation of economists because emissions are a classic externality. If you've studied economics, you know what an externality is. If you haven't, it's the situation is where you can emit without paying anything, emit greenhouse gases without paying anything, but this imposes a cost on the rest of the world. So you don't get to pay for you don't have to pay for the damages you cause to other people. And that's a classic externality, and a carbon tax, sometimes called a Pigouvian tax, is a classic solution to this. This might be implemented not by a tax, but by a cap and trade system, such as the way the EU is operating. An alternative is that governments can regulate emissions. That is, pass laws saying you just can't emit. Another thing that governments can do is they can subsidize renewable energy and other emission reduction investments. So that means the government is helping to pay for it. In the tax case, they're actually absorbing revenue from it. These are all ways to achieve the Paris and Glasgow commitments to net zero targets that governments have been making. But we are all concerned that the governments are not doing enough to reach these targets, that in many ways the targets are very ambitious, and there are a lot of transition risks that are going to happen, and governments need to start now to be effective in achieving their targets. But if the government doesn't do it, what can the private sector do? Well, the private sector can voluntarily reduce emissions. Net zero target commitments by firms are one way this might happen, but making a commitment is one thing, and actually making it happen is another one. And it's important that the net zero commitments lead to a lot of action, which would be, in fact, an implementation. Investors can also do something. They can hedge climate change. They can change their portfolios to some extent by over-investing in companies that are prepared for climate change and underweighting companies that are not. This is a strategy which we call a hedge strategy because it's going to outperform if the climate is worse than the market expects it to be, and it will underperform if the climate does not deteriorate as much as the market expects. As a consequence, this is a risk-reducing strategy. It reduces your risk to climate change because your portfolio is going to provide a kind of insurance. But like other kinds of insurance, there's a cost to this. What is the cost of this insurance? Well, it's underperformance if the market view of climate damages is more or less correct. However, if the climate damages are worse than the market expects, then this portfolio will outperform. It's a little bit like having a fire insurance policy on your house. If the house doesn't burn down, you've spent money and you don't get anything back. If your house does burn down, your insurance will pay very well. And so it's not clear that you want to have your house burned down, but you might want to have the insurance. So how much does it cost to buy this insurance? Well, in order to try to assess that, VLAB follows close to 200 sustainable public investment funds that have climate objective functions. It measures performance in traditional ways, such as just what is the return and what is the volatility and what are the Sharpe ratio, which is the ratio of return to volatility. It also measures it by its correlation with benchmark hedge portfolios. And so that's a new way of assessing the performance of these hedge portfolios. And we have two benchmark hedge portfolios that I will show you. One is called a stranded asset portfolio, which basically takes a short position. That means it moves in the opposite direction from what the stock market does for the fossil energy sector. And it shorts the fossil energy sector and goes long the broad economy. Therefore, it is a transition risk sensitive portfolio. It will do well if the transition risk happens because fossil energy sector will collapse and the rest of the economy will do all right. But that's transition risk portfolio. The second one is a climate efficient factor mimicking portfolio. We call this CEP, and this is made up of the best of these sustainable funds that we've just been talking about on the VLAB website. The best performing and the greenest of these funds. So we have a way of measuring whether they're green or not, statistically based on when there is news about climate change. And so we select the best of these funds, we put them into a portfolio, and we say that's a second benchmark portfolio. Okay, so here's what we see. So here's a list of funds, and this is, you can see this if you go to VLAB and look for the climate section. Here is a list of portfolios. You can see the names. Here's a global carbon strategy. Here is carbon impact, global lithium battery tech, quality dividend growth, nuclear energy fund, quality ETF dividend. So anyway, this is 10 out of 170 funds. These are the top 10, and the first column is the returns over the last year. The second column is the volatility over the last year. Third column is the Sharpe ratio, which over the last year, and that is a measure of performance of these funds. And I have sorted these by the Sharpe ratio, but you can sort them by anything up here. So one of the things you see is that only 5 of these funds have positive returns over the last year. Now, the market is having a hard time, but these funds are not performing particularly well. The new way of evaluating these funds is the last 2 columns. And here you have what is called the beta on the stranded asset portfolio, and this is the beta on the climate efficient portfolio. And so the greenness of these funds has to do with how correlated they are with the stranded asset portfolio and how correlated they are with the climate efficient portfolio. And these are actually estimated coefficients, and underneath are t-statistics. If you've had some statistics, you can read that. But some funds are heavily weighted on the stranded asset portfolio. Some are heavily weighted on the climate efficient portfolio. Some are not weighted on either one. So this is what we call 2 flavors of greenness. One is the transition risk and the other is this climate efficient portfolio. And we're doing this, updating this every day as a service to people who want to know what kinds of portfolios are likely to be good climate hedges. Well, how did these benchmarks do in the past? Well, between 2020 and 2021, the annualized climate factor mimicking portfolio had an alpha of almost 70%. That means that when you look at this portfolio, it has conventional risks, which should be rewarded. But once you calculate those risks and the returns that would be expected from them, this portfolio outperformed the market and all the rest of this by 70% per year. The stranded asset portfolio outperformed by 30% per year. So this shows that during this period, results which both Morningstar and BlackRock and other Wall Street companies have noticed is that sustainable funds actually did extremely well. And so the question is, why do they do so well in that period? And I think the answer is the pandemic looked like a very severe form of decarbonization. We stopped driving. We stopped flying to meetings. I didn't fly to Ukraine to give this talk. There are so many things that stopped happening during the pandemic that the demand for oil and the profits from oil and gas companies fell dramatically, just as you would expect in decarbonization. And so these portfolios performed what they were expected to do. But in that case, why are most of these funds underperforming now? And the answer in a simple sentence is that the global stock market has declined over the last few months, but the fossil energy sector has risen dramatically. So this is kind of the opposite of what we had designed our sustainable portfolios to do, because they're typically long the stock market and divest themselves of fossil energy. So what are the reasons for these 2 events happening? Well, for one thing, fossil energy prices are strong and profits are strong because the demand is growing as economies are growing, but the supply has shrunk. Why has the supply shrunk? Well, partly because of the Ukraine war and partly because of sanctions and cutoffs. It's also partly because the private sector reduced investment in fossil energy through investing in hedge portfolios and other private investment plans that did not include as much oil and gas drilling as they maybe had in the past. Secondly, inflation has risen around the world because of strong demand and supply constraints. Many of these supply bottlenecks are due to COVID, because COVID still shuts down businesses and shuts down transit networks, makes transportation more expensive and difficult. So COVID is one of the reasons for supply bottlenecks. Another one are the geopolitical tensions. And geopolitical tensions in the Ukraine are certainly part of this, but geopolitical tensions between China and the West are also a part of this. And so economies are strong, but there's a lot of inflation because the supply shocks have reduced the ability of the economy to produce goods and services that people are demanding. And of course, these supply restrictions have led to higher prices, which is inflation. And so we have inflation in many countries, and interest rates are being increased to do this. And this increase in interest rates is likely to cause a recession. And so we have recession risk and declining asset prices corresponding to increased inflation and higher interest rates. There's a lot of bad news on this page, I'm sorry to say, but there are a lot of things happening which have been hard on both the economies of the world and especially the asset markets. And here's a picture, gives you the idea. COVID might be less important today than it was some time ago. Recession is looming as possibly more important, and climate change is still the elephant in the room, as they say. So are these risks competing? Well, there's good news and bad news. High fossil energy prices were always going to be a part of decarbonization, because if you want consumers to stop spending so much money on fossil energy, one way to do that is to make it expensive. And so from a climate point of view, it might be good news that energy prices have gone up, but it's bad news for the population, at least in the short run. It might be good news in the long run because they get reduced climate damages eventually. The second piece of this is that utilities and governments will seek ways to increase energy supply, and much of this will be targeted to renewables. Some, however, will be investments in expanding fossil energy supplies. These expansions are designed to be temporary, but probably will have extended lifetimes due to the desire for energy security. So this is going to be bad news for climate, but good news for the population, at least in the short run. So we have good news and bad news from the rise in energy prices that we're seeing today. There is another link between climate risk and geopolitical risks that I think could be important. I ask myself, why did Putin decide that now is the time to invade Ukraine? There are a lot of reasons, I'm sure, but one of them, I think, is that climate change could be part of the answer. As the world decarbonizes, the demand for oil and gas will decline, and thus Russia might be economically weaker in the future than today, even without the war. Furthermore, the rapid development of renewable energy resources in Europe would make sanctions easier to impose in the future. These may be the same point, but they're a suggestion that this might have seemed like it was a good time, an important, sort of a last chance for Russia to do something like this. I don't know whether it's true or not, but this is this is my guess that there is a link here between climate risk and geopolitical risk. At the VRI, we study many different kinds of risks. I mean, we've talked about a lot today: geopolitical, climate, pandemic. We haven't talked about cyber risk, but obviously cyber risk is likely to be a key part of what's going on in Ukraine now. Financial risks and macroeconomic risks. However, we study all these different kinds of risk, but they don't happen one at a time. And often more than one risk arises, and they often exacerbate each other. That is, that one makes the other one more serious. So we call these compound risks. And compound risks are, I think, what we're seeing today. Geopolitical risk is creating macro risk, and climate risk is adding to geopolitical and macro risk. Pandemic risk is also creating macro risk. And so these are all interlinked together. So strategies to manage risks cannot assume that they arrive alone. And this is an important new area of research, which we're working on as hard as we can. So I'd like to stop here and leave you with a picture. This is a picture of three of my grandsons looking out at a lake. It's actually the lake you've probably seen in the background behind me. This is a lake in Maine. It's a beautiful, quiet lake full of natural beauty. But as you look out at it, you wonder, is it always going to be calm like that? Is it always going to be beautiful? What's the future hold? What kind of world will these children inherit? And that's why we're working so hard on so many different things at the VRI, and you are working on so much in the Ukraine. The world is trying to solve these risks. If we can tell them that we have it solved, they'll be a lot happier. So thank you.
Thank you very much. We have some questions today. Like the first question from Vitaly: what change of investment portfolio can have for private investors due to war and global COVOL?
So what changes should private investors have due to the war in Ukraine?
Yeah, due to the war and global COVOL.
Oh, global COVOL. All right. So it turns out when you look at these events in global COVOL, they don't have the same impact. They impact all asset prices, but they're not equally big impacts. So some countries are more impacted by global COVOL and some are less impacted by global COVOL. So it's not really easy to predict global COVOL, but it is possible to hedge it. And you hedge it by reducing your exposure to the most sensitive countries or asset classes and increasing your exposure to the least sensitive asset classes.
All right, thank you. And the next one, also from Vitaly: how to diversify portfolio risk of green investors?
What is the risk of, could you read it one more time?
How to diversify portfolio risk of green investors?
For green investors?
Yeah.
Yes, well, that is exactly the problem. If you think that the economy is partly green and partly brown, and you want a hedge portfolio, you're not going to be fully diversified. In other words, the hedge portfolio is going to have your reduced or possibly negative exposure to at least one and maybe more sectors of the economy. So it's taking a view or a hedge and will not be completely diversified. Now, there are strategies which some professionals have developed, which say that within the energy sector, there are some greener and some browner companies. And so you can maintain your energy exposure, but change your weighting between the greenest of the energy companies and the brownest of the energy companies. And so you will have less efficient hedging, but better diversification.
All right, thank you. The next one, in your estimation, how long will it take to reduce CO2 emissions to a sufficient level to stop climate change?
Yeah, that's a good question. I would love to know the answer to that. The countries of the world have settled on 2050 as the date at which they are all hoping, more or less around 2050, to be able to reduce emissions to net zero. And net zero would mean that there would be no added accumulation of CO2 in the atmosphere, because the amount of CO2 that is being pulled out of the air would be the same as the amount that's being pushed into the air. So that's a goal. That doesn't mean that it's possible to do it, and it doesn't mean that it's likely that governments will actually achieve this. But at least that's how long they are planning on doing it. And the reason for that particular date is that if you can stop the increase of temperature in 30 years or 28 years or whatever, then the damages that we predict might not be, are thought to be manageable. If the temperature rises more than that, the damages increase rapidly as the temperature gets higher and higher. And there are some points which are called tipping points, which if you cross those tipping points, then there is no return back to normal.
All right, the next one. Do you support the transition to electric cars, or should humanity look for other alternatives?
Well, I think the transition to electric cars is a very important part of decarbonization of the economy. It won't do any good at all, however, if the electricity still comes from coal-fired power plants. You have to clean the electricity supply as well as converting to electric cars. It's I think pretty likely that electricity will play an ever increasing role in a decarbonized economy. So the growth of renewable electricity is going to be absolutely key. And some of the new technologies which are being considered, such as hydrogen-powered airplanes and hydrogen-powered ships and so forth, actually require using excessive extra electricity to make the hydrogen. And if it's renewable electricity that's making the hydrogen, they call it a green hydrogen. And so that the demands for massive amounts of renewable electricity are going to be very severe.
Okay, next one. There are rumors that cryptocurrency also pollutes the environment, not directly, of course. What kind of money is more environmentally friendly, virtual or real?
Well, not all the cryptocurrencies have this mining feature, but Bitcoin, which is the first and I guess the biggest still of the cryptocurrencies, has a provision that you can earn Bitcoins by performing a mathematical calculation, which is actually designed to police the way the network works. But this mathematical calculation takes computers, massive computers, a massive amount of time to do. But because Bitcoins are so valuable these days, it's a profitable business. And it takes an enormous amount of electricity to run all these computers. And it's, it just isn't clear that this should be a part of a decarbonization plan. It's not what, if we want to use this electricity to help the environment, mining Bitcoins isn't really what we should do with it, in my opinion.
Okay, and what do you think will we use in everyday life these cryptocurrencies in the future?
Sorry, say it again, please.
Will do we use cryptocurrencies in everyday life in the future?
Will we use cryptocurrencies? I don't think so. I think they're too complicated. Was it San Salvador, I think, that has made cryptocurrencies legal tender as well as US dollars. And there is some recent evidence that almost nobody uses Bitcoin. They all use dollars for transactions. I think that the main use of cryptocurrencies might really be in great big country to country or central bank to central bank transactions where, or maybe bank to bank transactions where there are large amounts of money and where the float, that is the time between when you send the money and the time when it is received, is expensive. And crypto has the advantage that when you receive this, you know you have it. There is no time interval where you have to wait for your check to clear or your stock trade to clear, something like that. So I think that might be the most likely place for crypto to be actually used. I don't think it's a good currency because it doesn't have stable value. And even the stable versions of cryptocurrencies are not stable, as we've just seen. So I really think cryptocurrency is a purely speculative market right now. I don't think it's going to have substantial economic uses that are, but I could be wrong.
All right, thank you very much for a great lecture. It was a great pleasure to see you and listen to you today. I wish we will meet in peaceful Kiev when everything will be fine and do lecture in person with a huge amount of people.
Well, I look forward to that myself. Yes.
Thank you very much.
Thank you.
Day.
Okay, bye.